All right, we're back. I know it's been a little bit since I've done an update, and I was wanting to do this on a weekly or bi-weekly basis. So I apologize for that, but I figured it was time to do a little bit of a portfolio update. Given last week, the market, the volatility has been pretty high. So I just kind of wanted to go over, current positioning, how things are going. Basically, beating the market from a percentage standpoint pretty well at this point. Obviously, there's no guarantee of that, but I just wanted to go over, why I think that is, and why I think this is maybe a robust approach to, option selling, and kind of go over some of the pros and cons and some of the things I've been seeing, this year so far and what might happen. So we can just kind of dive into stuff. This is in my Tasty account at the moment. As you can see, this is the year-to-date, gain and loss. You can see realized gain, year gain, commissions, which is pretty crazy, and fees, which is one of the downsides of using futures. But I guess you kind of pay for the leverage one way or the other, so that's kind of how it goes. So obviously, what I think is kind of annoying is Tasty shows this as your profit and loss, like overall, right here, the like year to date doesn't actually show with the fees taken out. Obviously, there's a strategic reason for that, I'm sure, but you can see that's a decent difference. But in general, if we go over to Options Autopilot, and if anybody doesn't know who I am Ben Collins, CFA charter holder. I'm the founder and CIO at Options Autopilot, which is an automated options platform that I created with my buddy Zach, who's a Google engineer. And basically, it helps automate all option strategies. So check out the link if you want to learn more about that. We also now have the course inside of here. So what you would have to do is, this is totally free if you want to learn to manually trade. I think it's pretty in-depth. Some people probably don't want to go that in-depth, but I do think you should learn, why you're making money or losing money when you're dealing with options. So what you would do is request access, then we'll send you a link. And once you create an account, you get access to the course. If you wanna learn some more about that, and I'll leave that stuff in the description. So what we can see here, net liquidity is 34,500. Basically, this is different than my actual P&L year to date, because some of the stuff has been done outside of Autopilot. So I kind of want to go over some of the pros and cons of some of the stuff I've done manually. And I've actually mostly lost money not using the automation. So on one hand, it's kind of proving out, which is what I expected, right? But I do still do a little bit of a tactical stuff, because I think that you can make some money going directional at times, but you need to be fairly consistent with it. And so far it's been a net negative, but some of the stuff has been helpful, so I'll go over that. And I will try to go as quick as possible, because there's a lot to cover. I don't want to make these super long, but then I end up kind of giving my analysis that takes a while. But in general, go back over to Tasty. You can see this is my crude oil positions. We're doing the 111 on that for the most part. ES, obviously that's the S&P 500. GC, that's gold. Gold's been a little more volatile for sure. I think maybe it's topping out. We'll look at that. Excuse me, I don't know what's going on. But MES is the micro contract. What's been interesting is, since the last video, MES, I believe, has gotten a lot less liquid. We've been noticing that with users on Options Autopilot, that it used to be a pretty good tool to have a little bit lower exposure. You can kind of more scale it up. We might have to switch to XSP, which is the smaller contract of the SPX, but I'll have to compare that. I mean, it's not terrible getting in, but getting out of it is sometimes a challenge. Like, we could have our orders sitting there, and we're technically above the bid and ask, or the midpoint, and it'll sit for a while before it gets filled. So I don't necessarily like that. Again, if you still hit your profit target, that's fine. It's more of an issue. Obviously, we want to have the stop loss be accurate, and we want to be able to get out, and we want to be able to get filled. So I asked Tasty about that, and they're still getting back to me on if there's really any kind of difference there. So that's one thing that I've definitely noticed and might have to adjust, moving forward. This is the 30-year bond futures. You can see. So for the most part, Bitcoin has actually been negative this year. So not everything has worked out, but for the most part, all the asset classes, yeah. So we're up a little bit on crude oil. Maybe after fees we're not. I guess I gotta have to look at it. Barely. So, but it's kind of proving the point that the diversification. So let's go and look at that cross asset tool, which I kind of talked about in my 2025 plan, because I wanted to point something out that people need to be aware of. So if you don't know what this is the CME group kind of tools, and I don't think I ran into this before, so this must be new. I'm assuming it's not our fault, but they basically made this so you had to create an account to use it. They had to create an account to use it. So it's not free to use. I mean, it's free. You just have to create the account. But I didn't think there was any kind of gate before. So just keep that in mind. You have to create an account to use this, but it is kind of helpful. So what we're doing is looking at all the current futures and asset classes that we're trading. This is Euro USD, just to see if it gives us any information about dollar strength or weakness, and how it's kind of related to all these things. Right now I'm not doing anything with currencies, but we will likely add that into Options Autopilot in the future, so you can kind of more easily use this if it is kind of robust, because you can see that there's a decently low correlation to each asset class for the most part. So that's something to keep in mind. But what I did want to point out is, correlations will change over time. And I definitely was noticing a little less of a benefit from all these asset classes more recently. And that can happen. I haven't fully checked out how we could test what's called crash beta. And what that term is when things move all together at once, when things sell off. But if we look at the date range, right now it's 6 months. I think we were looking at 6 months in general. I mean, if we look at 1 year, gold is pretty low correlation. All of them are pretty low correlation across the board over a 1 year time frame. Obviously, 6 months, still not bad. 3 months, it's definitely bumped up a little bit. And what was interesting to me is if you go to a 1 month, you can see that this is the Treasury. So Treasury rate was actually 70.70 correlation with gold, which I find interesting. And some of this stuff has obviously become a bit more correlated. Some of it's still pretty low or negative, right? This is all the reason why we're trying to go across asset classes. And not just only do it on the S&P 500, just because they will move not together all the time, which is what we want. That's usually what you're trying to achieve with general portfolio asset allocation diversification. As people say, it's the only free lunch in town is when you have the ability to diversify your portfolio. So that's what we're trying to do for options, right? We're still selling volatility, but we're trying to do it on different asset classes. And I'm trying to make it mostly equal across the board. Of course, ES is the more liquid version of all of these things. So it's, always going to probably have a higher component to it. But, when VIX spikes, obviously that mostly impacts ES in general. But that's, the current state of the market and correlations right there. But in general, I would probably just, keep an eye on how this is maybe changing on a weekly basis. So this is interesting. I don't think you really need to analyze it on a short term, because if you're just staying consistent and automating it, you should be benefiting from the longer term correlations as long as you're doing it over that time period. But this tool I think is very helpful. Maybe we'll try and create something like this. Maybe I can embed this into Options Autopilot. I've talked to Zach about maybe doing that. But we've been working on some other stuff. So that'll be farther down the road for that standpoint. Another thing, looking at the market, I don't do much in terms of technicals, in terms of I guess tools and stuff like that. I do pay attention to the McClellan oscillator, which is kind of a broad overall overbought, oversold kind of situation. And ultimately, again, this would just be something you could reference for if things are at extremes. And what you need to keep in mind is things can always go more extreme. That's why you have to manage risk. Don't, bet the farm on any of this stuff. These ads are annoying. But that's what you get when it's free. So ultimately, we were kind of probably looking to finish somewhere down here until the market kind of recovered and ended up ripping higher. I would have guessed that we would have at least gotten to the minus 200 range, which is, of course, now we're losing the power. One moment. It says pause. I don't know if it actually pauses. Okay, and we're back. Hopefully that worked. So yeah, this was getting likely to an pretty extreme oversold position, but then the market did kind of rip back up, on Friday. So, it's still sitting here. It's kind of in a little bit, lower below these averages, but it's still not at super extreme levels. I've thought about, again, in the future, plans would be having sort of a extreme tactical position selling of volatility, but that will be longer term, kind of like actual strategies outside of the typical kind of just consistent putting on a vol, and obviously we want to back test to make sure that is actually helpful. But if we look at S&P 500 year to date, it's actually down 1.49%, 1.5%. If we look at NASDAQ, it's going to be even more, I believe. Yeah, so 3.61%, down. So things have actually gone negative now for the year. I wouldn't say it's, predictable. You don't necessarily know, but, valuations were getting stretched. Yes, definitely going into the year with Donald Trump getting elected and kind of everything I'm doing, going up in anticipation, it seemed. They're kind of, buying the rumor and then selling the news. But you can see that we're still doing, pretty well. I'd have to go and figure out the exact percentage because I definitely have, added a little bit of capital, but I believe, let me just roughly do this. I think I'm up 9% or 10%. I want to say it's like, I'd say it's approximately 10%. So obviously we're significantly outperforming the market. Not always going to be the case, but again, with the diversification of all these positions, then that is what we want to have happen. What I currently have on right here, 2 ES positions. I've disabled the MES ones just because I basically wanted to move to ES for now. So you can see I still have some hedges on. These are hedges that I left on from a while ago, and they still have 69 days to expiration. And as we can see, as the market sold off, like they've basically gotten, at one point, this one was in the money. And that's kind of how far down we were. I mean, now it's at 58.26, but this was in the money at some point. So I figured it probably just makes sense to leave it on. It'll probably end up expiring worthless, but you just never know because, ultimately each one of those I probably would make $500. So, and I already took the profit off for the credit on the short puts there. So we'll see. This one's currently sitting in the money as well, and I'll be curious to see how this actually plays out. So we've got a couple positions on. I upped the quantity to 2, so I've got technically 2 111s on MES at the moment, and then I also have 2 111s on with ES. So that's kind of the current positioning. I I did one on Friday. I think I did one on Wednesday. I'd have to double check when they went off, but um, obviously they were down at certain points. So don't look at this and be like, oh yeah, it's so simple. They were definitely down at certain points during the market sell-off, but ultimately I thought that we're putting them on at pretty good levels. So you could see that our long put is decently below the market, and then our actual naked short put is at 4,900. I don't think that we'll get down there. Anything's possible. You always got to assume that. Same thing with this one, 4,850. I don't think it'll get down there, but you just never know. I did get stopped out on some positions. So basically, the system's working as it should be. Obviously, it's annoying to take losses, but that's the whole point of having the stop loss there. I think I got stopped. Yeah, I definitely got stopped out on some gold. Let's look at what's actually happened. I can kind of tell you. So obviously these were, from Options Autopilot. Was this close? Yeah, so that went off as well. I want to go over, I did an NVDA position over earnings. It was kind of stupid. I mean, I ended up making money. It wasn't stupid from like a strategy standpoint, but it's kind of like, it was kind of pointless. Like I made 100 and I can't remember. Let's go look. Because I basically thought that it might miss or at least fall over time, and there would be volatility crush. So I sold a farther out and farther down put, and that kind of financed a more near-term put spread, which in general I wouldn't recommend. But okay, so I basically made $182 on that overall position, but it required a bunch of management, so it's really not worth it in my opinion. Intel has been this is the example of where my human psychology is not helpful. I basically I've been waiting for Intel to either kind of recover or return to some former glory. Part of me thinks there's going to be someone that comes along and buys it out, but maybe it's too big. So it finally seemed like it had bottomed, and some of the news had come out where it was starting to rip higher. Tasty just changed their setups, and I'm just kind of lost here. So we look at Intel. I was definitely late to the trade because I had been watching it for a while, and I was like, okay, I should do something here, of course, right? And then it starts to rip, and then I did get into it, around here, and then it ripped through here. I closed it, and then I started to sell, some puts on it, because I'm fine holding the stock, but you can see this was just a total fake out, right? Because I was kind of thinking then it got close to filling this gap, but I was thinking once it broke here, it would maybe fill this gap. But now you can see it's come all the way back down here, and I'm sitting with $1,000 loss almost, right? Now year to date, I'm only down 368 because I did make some money on the calls originally. So again, that kind of just goes to risk management and not getting too greedy. But it also is kind of stupid, right? It's like I'm focusing on an individual position that I don't necessarily need to do that. I started to do some stuff on SOFI. I thought that's gotten kind of cheaper to a point where I would maybe want to buy it. So I kind of did a long-term collar. So I sold some, basically leaps almost. Well, they're not 2 years, but I sold some puts, bought some calls. It's kind of unbalanced, so I'm expressing a long position there. I've been in and out of SOFI, but again, is it really worth my effort? I don't know, but I wanted to be have a little more diversification just in case things started to get a little bit, dicey. So it is approaching this very kind of long term again. This is what's very frustrating. Like I had leaps for a long time, basically 2-year leaps on SOFI, and all it did was this BS, right? And it seemed like it was gonna break out, and then it doesn't. And then it finally did, and I didn't have my calls on, right? And that's why automation is very helpful. I probably talked about it before, but I digress. So this kind of level I think is pretty major, and you can see it's kind of reverse. And I would say if it gets down to this $10 level, it should find support. We don't know, but that would make this kind of short-term double top have played out, and then hopefully there's some support there and things can kind of resume. That's what I'm thinking here. ARK. I probably have an unpopular opinion of Cathie Wood. I think she's just a salesperson. She has really smart ideas, but and she obviously sounded really smart during COVID. But I think she's just a salesperson at this point. Getting so huge, size is an enemy when you are looking to get returns. So, it's not fully her fault, but I think she just always continues to double down on her positions, and all she's doing is dollar cost averaging. She's not really doing anything different, in my opinion. You guys can comment if you think differently. So another one, XRP. I've never been into any kind of cryptocurrency. The concept and the idea of the banking system moving to something like that does make sense to me. I don't know why XRP, again, I'm semi-ignorant. I don't know why XRP specifically would benefit, but I've heard the story. If anyone watches Andre Jick, he talked about it. I've had multiple people talk to me about it, which maybe means it's top, right? But I figured maybe it's worth a little bit of exposure. It's not that much money. It's like $2,700. If it really was going to 100x, then sure, right? Maybe have a little bit of exposure. So that has more of a convex payoff potential, in my opinion, even compared to something like Bitcoin. You can see Bitcoin, I still have my short put spreads on there. So, I've got 5 total put spreads on there for IBIT. And let's go look at that chart. See if I can rip through these a little bit quicker so I don't make this an hour long. So in my opinion, Bitcoin looks like it kind of topped, right? Based on the ETF. And now it's just almost did like a classic retest here. And now it's turning over. So I wouldn't be surprised if it moves back into this area. But, I'm not necessarily changing my strategy. As we can see, I was still break even though the market, it's not really going higher. And the whole point of the automation is just if it's falling, obviously if we get stopped out, it'll put on another position. Let's say it's down farther again. We're just kind of selling under the market constantly. And if we can do that over time, we should be able to make money and remove the emotion from it, right? So that's the whole benefit of the automation itself. But, Bitcoin has been not profitable, but I do like it as a diversifier from that standpoint. So we're doing the 1-on-1 on 30-year bond futures. I think that, the rates have started to move back higher. So we are in an uptrend, in my opinion, now. Last time we looked at it, it looked like it was finally, I don't know why I just did that. It looked like it was finally starting to, let's just do this. It's kind of close. It's not exactly the same, but it looked like it was basically finally breaking a downtrend in general. I don't know why these drawings, I feel like, move when I haven't touched them. But so it looked like it was kind of breaking this, and it does look like now starting an uptrend. It should hold here, but there's no guarantee. We'd want to see it hold there. Which hopefully means that rates are actually going to drop again. But, the market will do what it's going to do. Ultimately, we're just trying to, earn the return from selling the volatility. So that's part of the reason that I wanted to do the 1-1-1 on the bond futures, just because correlation to S&P 500, usually if there is a flight to safety, bonds should benefit. Not always the case. Didn't happen in 2022. So you got to be careful of that. That was one of the few times, in history that I think bonds were selling off, and so was the market. But, that could be, a new norm, but I don't think it's going to be as extreme as 2022. I do think the Fed has a lot of, room to help out, which is going to help the market. Again, you always got to assume that there could be sell-offs. I personally think there could be, a plus or minus kind of 10% range for the market. It's interesting because I think there's levels where, people say, oh, it's entered a bear market when it goes down 20%. It's kind of like looking at something go on sale. If it's 10% off, you're not fully compelled to buy it. Same thing with probably institutions and investors. If people are, holding cash, they're like, well, sure, 10% off is nice. If it gets to 20, then they might see some significant value there. I guess I should go over ARK. Again, the reason I did that is I was looking at Tesla and OKLO and seeing those kind of moves, and I didn't really want to take more individual stock risk, even though I think that those could move pretty well. I just figured they're probably kind of embedded into this type of movement, so I just ended up doing a position on ARK. Again, this is not through Options Autopilot. This was just a put spread farther down. So again, it's working out so far. Who knows? I'll probably just import that if I can into Autopilot and have it manage it. But that was just kind of trying to find a little bit of an uncorrelated play because I didn't want to be adding again on top of S&P 500 positions. Same thing with SOFI. It's hopefully a little bit less correlated. So you can see right now I don't have gold and I don't have crude oil on. I closed those out. They're pretty close. They're like mid 50s profit target. I just wanted to kind of reset because things had been a little bit volatile. So let's look at those real quick and then we can kind of wrap things up in general. I mean, this was a pretty big move. I got stopped out of a position from this, a little bit unexpected. So as we were looking at this, I think before even I was talking about how, it had broken this downtrend and then it started to move up, right? And then it started to move back down. So we're still technically, let me just double check so I don't misspeak. I think we saw that we're still technically up overall, but we have been whipsawed for sure on it. So it's definitely not been all fun, but that's the whole point of having automation help you manage those positions, right? I didn't have to watch it. It just did what it needed to do. My automations are set to run Tuesdays for the most part, so it'll put those back on. But that's definitely some damage. There's definitely some damage happening on the charts here, and I do think there's potential for there to be demand here, but this was a pretty big move down. Let's just look at sometimes it's easier to look at the ETF instead of the actual futures contract. Again, I mean, it was interesting that there's been some fake out, it seems like, right? So it did break out and then looks like it was making a new high and then fully reverses. So that's just, the market, and you just got to stay consistent. So I don't want to sound like a broken record. That's part of the benefit of automation here because options should be overpriced over time. But you just got to do the same thing when you should do it. So basically, I'm hoping to put, a 101 on, and it should be, farther below the market, because if tensions flare again, usually oil is going to go to the upside. The other thing I would think is you should get a little bit of a bid going into the summer driving season. So all that stuff, I'm just trying to think about and should help with diversification on your portfolio. So, keep that kind of in mind. And, that's the type of stuff I'll kind of think about and why it should help you over time. Gold be the last one we can kind of cover. again, it looks like to me the uptrend is broken. It came down and tested this kind of other high and then bounced. But to me, if this continues to roll over, I would say that could be a double top and could start a downtrend. We don't know until it actually happens, so that's why it just makes sense, I guess, to stay consistent. Again, on gold, we're doing put spreads. The 111s just don't work out very well from a return on your risk and the margin required. So it's not an efficient use of the margin for doing the 111s on those. So that's why I'm sticking with the put spreads and just kind of staying more consistent from that standpoint. But yeah, that's pretty much what I'm seeing. Oh, I guess we should probably talk about S&P 500 in general. Okay. I would say this is definitely looking like a top. So I'd be a little bit cautious. You can see that VIX was spiking higher at times. I guess I should go over that too, because I was going to go over some of the manual stuff I did. This definitely looks toppy. A lot of stuff is kind of looking toppy. So that's where some of that stuff can maybe become a little bit more correlated. And you do get increased volatility around trend reversals. I'm not claiming that's going to happen for sure, but I definitely would be a little more cautious here as we're looking at this. But that should provide some kind of benefit, longer term if you're looking to get, long some stocks. If anyone's not familiar, technically if a double top happens, it theoretically should project, if you believe in technical analysis, should project down the amount that basically that double top is. I believe it's about 400 points. So, around the 5,300 mark, you might find some support. I'm not really much with like Fibonacci's or anything like that. I think that Fibonacci's are kind of like they can do wherever you place them, right? And I don't put much value there. I just kind of want to see support and resistance levels, where people are buying, where people are selling. And it's more just for risk management purposes in general, to kind of use those types of levels. But when you're automating it, you don't really have to pay attention, but some of that stuff is just better to at least keep an eye on from that standpoint. One thing I was going to touch on real quick, I did put on a hedge with VIX at one point because things had come off. The VIX was lower, and it was at a point where I had more exposure Vega wise, and so I kind of wanted to cut my exposure a little bit and feel a little bit better. So I did put on a call spread. It was a front month VIX call spread. I think it was a 25.35, and I put it on for like 40 cents. So if anyone's heard of the 50-cent trader, not the wrapper, but there's supposedly some big institutional person theoretically that buys call spreads usually for 50 cents on the VIX as hedges supposedly on their other portfolio. I wasn't necessarily following that, but I just noticed that I was like, okay, this would give some decent exposure if we got kind of an extreme move on the VIX. I guess we can look at when did I do that, and then we can look at the chart. I think I only had it on for a few days. That's the annoying thing about doing that type of stuff is, so I sold it for 91 cents, which was annoying because it was I was way below the mid. So that's one of the things about it not being very liquid. So I bought it for 42, sold it for 91. It's one of those things where it was sort of a tactical hedge, and I just wanted to cut some of my exposure if the market started to get a little crazy. And if we go to the VIX chart, we're gonna add to Autopilot the ability to maybe do that on a more consistent basis, or more tactical basis, just if people want to kind of do those types of things. I think there are better ways, and it only matters if it's because I kind of had more exposure on ES, right? It only really matters if you're trading almost exclusively just the stock market. That's again why I would say, be diversified on other asset classes. Sorry, I forgot to look at when this actually was. This is really annoying that it always switches back. Tasty needs to fix that. Come on. So, what was this again? And this is why these videos can go too long, but hopefully this is educational. If it is, give it a like, share it with someone who would benefit from this, and get in on Options Autopilot, or the course at least. So, okay, this was February 26th. This was when I bought the put or the call spread. Sold it on the 4th. So about 6 days, about a week I held it. So the 26th. Where was it? Okay, so I bought it here. So it started to move up a little bit. It was right around 18, I believe, when I did buy it. I don't fully remember exactly, outside of, just feeling like I had a lot more exposure on with ES positions. So I wanted to cut it a little bit. And I thought this was going to be, a decent way to do that and just leave it on. But usually what happens is, moves up and then it fully bleeds off. And when I benefited from the hedge itself, I was like, okay, here's a chance to establish, maybe shorting some vol, because that would be a good time to short. So I ended up shorting some vol, closing down the hedge. That was here then? Yeah. So I ended up closing it down. Again, could it keep going higher? Definitely possible. I think there would have to be some significant news to move it higher, right? This was a huge spike. Obviously, that would have been the time to have those hedges on. I think, that's again another annoying thing, right? And this is what normally happens. You normally don't benefit from hedges. Obviously, they're just a sunk cost, but you kind of do it to hopefully protect yourself. I had calls on VIX that expired literally, I think, this day. Okay, and I didn't put it back on. Had I done, a few months out, I wouldn't have fully benefited, but literally the next day, this would have been, worth tens of thousands of dollars. So that gets annoying, that it's like you don't have it on when it would really help. And that's why I think being kind of consistent with it would be helpful. But that's why we have the kind of converting the 111s and the 112s into hedges itself. It's kind of a better direct play on there. But I'm open to ideas if people want to comment, but we're going to definitely try and integrate some more kind of dynamic hedging based on certain market conditions for Options Autopilot. Just because, these types of scenarios can be detrimental, but that's again where you want to diversify your positions. Don't want to sound like a broken record, but that's what it is. There's no free lunch in the markets and nothing is guaranteed. So that's why it's good to spread it across multiple asset classes. That's what I'm doing. That's how I'm technically beating the market. Automation and diversification is the name of the game. So I hope you guys appreciated that. Appreciate you watching. And yeah, I guess that's about it for now. I'm going to do a couple other videos, hopefully in the near term. But appreciate everyone's, requesting to get access. Options Autopilot, that's now, fully flushed out from the core standpoint. We had it on a Wix built-in thing, but now we finally moved it to a much easier, better way to navigate that, that we can let people get on there. So didn't want to focus the time on the website necessarily, more on the actual software itself to make that better. So that's why it took a little bit of time. So get in there, ask any questions obviously below. send an email if you have anything, and we'll see you in the next one. Take care.